The red candles bleeding across your screen right now are a carefully orchestrated hallucination designed to make you panic while the world's most powerful financial ghosts move in for the kill. While the average trader is distracted by a 27% price slump, we are performing a forensic audit on a massive, systemic liquidity vacuum that has already surgically removed 170 million tokens from the public order books. So over the next few minutes, we are going to be deconstructing the fingerprints of a $35 million algorithmic takeover, mapping the 18.5-second pulse of institutional bots, and revealing the exact mathematical autonomy of the impending supply shock that is currently starving the exchanges of their final reserves. By the time that we're done, you're going to understand why the birth of 42 new millionaire wallets in the middle of a crash isn't a coincidence. It is a roadmap, and you're going to have the exact sovereign protocol needed to mirror these whales and secure your position before the exit doors to the legacy system lock for good. The charts on your screen are a carefully constructed lie designed to make you quit. Now you're looking at a portfolio, right? And it feels like a crime scene. XRP is bleeding out, and since the start of the quarter, the price has plummeted about 27%. It is a gut punch that's forcing retail traders to dump their bags in a blind panic. But while you're staring at the red candles, something impossible is happening behind the curtain. The very people telling you to sell are actually clearing up the floor. Look at this heat map. While the price line craters, the heat map for wallets holding between 10 million and 100 million tokens is turning bright red. Now this isn't a coincidence. It is a calculated transfer of wealth from panicked individuals to silent, massive institutions during a planned price dip. This is what we would call a divergence trap. Most people only look at the price, but the price is just a distraction. Real wealth is tracked by movement. And while the news claims XRP is losing its grip, 42 brand new millionaire tier wallets have appeared on the ledger in the last month alone. Now these are not hobbyists. When you realize that only 2.4% of the entire network holds more than 10,000 XRP today, then you start to see how exclusive this club is becoming. The stock market is a device for transferring money from the impatient to the patient. Time is the friend of the wonderful business, but the enemy of the mediocre. Now, you see, these whales, they aren't just buying, they are surgically extracting supply. We are seeing a 14% explosion in the higher tier whale addresses. Now think about that, right? The asset is losing a quarter of its value, yet the world's biggest buyers are rushing in like there's a fire sale at Tiffany's. It's a classic shakeout designed to clear the board of weak hands before the next structural move. This chart tracks the birth of the 42 new millionaire addresses against the 27% price drop. It proves that the smart money isn't catching a falling knife. They're the ones holding the magnet. They are buying the exact moment that retail is most afraid to look at their screens. They want you to believe that the story is over. They want you to think the 2.78 billion tokens left on exchanges are a sign of weakness. But the truth is much more dangerous for those left on the sidelines. The supply is not just moving, it is disappearing into private vaults. And if you aren't watching the bots, you are missing the actual heist. You aren't trading against humans anymore. You're trading against a ghost with $35 million and a high-speed stopwatch. See, while retail traders scramble to read the latest panic-inducing headlines, institutional algorithms are operating on a completely different frequency. Now, we tracked a specific execution that proves that this isn't just random buying. It is a surgical strike. Over the last 48 hours, a single entity deployed $35 million into XRP. But they didn't just smash the buy button. They used a sophisticated ghost bot to slice that massive entry into tiny, undetectable fragments. Look at this heartbeat. Each spike represents one of the 156 orders triggered by this algorithm. And by spacing them exactly at 18.5 seconds apart, the bot ensures it never triggers a price alert or notifies retail scalpels to its presence. It's a rhythmic, mechanical absorption of every available token at these suppressed levels. This technique is the cornerstone of a zero slippage strategy. It's if an institution were to dump $35 million onto the market all at once, well, the price would skyrocket and they would end up paying a massive premium. So by bleeding the order books dry slowly, they get the best possible price while everyone else is busy looking for an exit. They are essentially building a massive position while keeping the price floor exactly where they want it. 2026 is shaping up to be another defining year. There's a huge opportunity ahead, and we are making sure XRP is the center of it. Adoption grows steadily with every milestone. Brad Garlinghouse signaled this shift months ago, and now we're seeing the mechanical proof. Now, the staggering entry is designed to be invisible to the naked eye, but it's not emotional. It doesn't panic when the news turns sour, and it definitely doesn't get tired. It just keeps clicking, 18.5 seconds at a time, until the supply is gone. Now, this is how the world's largest whales hide their footprints from you while they prepare for the next leg up. This comparison shows the difference between a standard market order and a ghost bot execution. Notice how the bot keeps the price impact near zero, the flat blue line, while the volume bars continue to stack up. They are accumulating massive weight without moving the needle, keeping the buy signal hidden from your standard trading tools. This is the anatomy of a stealth buy. They aren't looking for a quick flip. They are positioning themselves for a systemic shift that most people won't see until it is already over. And when you see this level of precision, you have to realize that you aren't watching a market collapse. You are watching a liquidation event for retail and a loading zone for the elite. With all of that in mind, it does raise a question. Why would an institution spend $35 million to buy an asset that the news is saying is dying? Let me know your thoughts in the comments below. The exit doors to the legacy financial system are being locked from the inside, and while the masses are glued to the price ticker, the real action is happening in the pipes. Now, we are witnessing the largest mass exodus of liquidity in years. Since the start of this year, exactly 170 million tokens have been surgically removed from public exchange order books. They aren't being sold for profit. They are being packed into cold storage vaults, far away from the reach of retail traders and the volatility of the day-to-day market. This visual shows the massive 170 million token stream flowing out of major exchanges into private encrypted cold storage. As these tokens leave the order books, the supply available for buy orders vanishes. This creates a physical liquidity vacuum that forces price tension to build like a coiled spring, ready to snap. This isn't just about moving money, it is about creating a calculated shortage. See, when tokens leave an exchange, they lose their immediate sell potential. And if you want to track all of this in real time, then our free Discord members get the on-chain alerts that the second that they hit the ledger. While our paid Discord membership community, they get the deep technical analysis to see exactly where these whales are parking their capital next. You can find a link to the Discord in the description down below. XRP number of days at a profit is currently sitting at historic lows. This usually indicates that short-term speculators have exited the market, leaving only the long-term high-conviction holders. We are approaching that breaking point right now. The total supply sitting on exchanges has shriveled to just 2.78 billion tokens. Now that number, it sounds like a big number until you actually look at where it used to be. The reserves are drying up at the exact moment that institutional demand is heating up. Now this is a massive systematic risk for, anyone who thinks that they can just buy in later when the news turns green. Compare the current 2.78 billion exchange reserve floor against the historic peaks of previous cycles. The supply on exchanges is now sitting at multi-year lows. This depletion creates an insolvency risk threshold where a sudden spike in demand could trigger a vertical price explosion because there simply isn't enough left to sell. The vacuum is real, the supply is being throttled, and while the average investor waits for permission to buy, the inventory is being cleared out by people who never intend to sell back to the public at these prices. If you're still holding your assets on an exchange, then you aren't just taking a risk, you're the liquidity that the whales are about to leave behind. Everything that we just uncovered could be rendered useless by a single closed-door session in DC. The math points to a massive explosion, but we do have to talk about the reality of the environment that we're in. Even the biggest whales aren't immune to a global shockwave. On February 28th, we saw exactly how fragile the market can be when the US-Iran tensions spiked. Now that flash crash wiped out millions in leverage in minutes, regardless of who was accumulating behind the scenes. Now it was a stark reminder that while the on-chain data is bullish, the geopolitical landscape is currently a minefield. This map tracks the immediate capital flight following the February 28th geopolitical shock. It shows how liquidity briefly drained out of risk assets and into stable havens like gold and RLUSD. This proves that despite institutional buying, short-term price action is still vulnerable to global instability, creating the noise that often shakes out retail traders. The risk isn't just about what is happening overseas, it's also about the gridlock right here at home. The Clarity Act is currently stuck in a legislative loop, and until we get the final stamp of approval, the massive wall of institutional money is still forced to move through these tiny, staggered bot buys instead of a floodgate. Now, it's time for that mandatory disclaimer, because this video is for educational and informational purposes only. Always remember that I am not a financial advisor, and that cryptocurrency markets are highly volatile, and you should never invest money that you cannot afford to lose. You should always do your own research. For too long, market participants have been forced to navigate regulatory boundaries that are unclear in application and misaligned in design. This event will ensure innovation takes root on American soil. This is the bridge that we're waiting to cross, and if you want to understand how to navigate these regulatory shifts, then we've put together a series of free courses over at thecheekyschool.com. And for those who want the full institutional grade breakdown, then make sure to check out the paid courses with the 50% off code that you'll find in the description below. You see, understanding the market is just as important as understanding the laws themselves. This countdown timer shows the 18 working weeks left in the current legislative session for the Clarity Act. It visualizes the narrowing window for a breakthrough before the election cycle. And if the clock hits zero without a vote, the supply shock remains a theory, while whales continue their stealth accumulation. We are in a race against time. The accumulation is aggressive, the supply is vanishing, but the political wall is still standing. And if that wall breaks, the vacuum that we've been tracking will finally be felt by the entire world. Ripple Labs is a $50 billion titan, yet the token it powers is being treated like a failing penny stock. Now the disconnect is staggering. Now in the first quarter of 2026, Ripple reported record-breaking revenue. They are closing enterprise deals faster than at any point in their history, but while the company's private valuation is skyrocketing towards the $50 billion mark, the price of the actual token has suffered a 30% bleed. It is a paradox that has retail investors pulling their hair out. How can the company be winning while the asset is losing? Look at this massive valuation gap. On one side, you have Ripple's private valuation soaring to $50 billion, and on the other, you have the XRP market cap struggling to keep pace. This widening chasm shows that the market is currently ignoring the fundamental growth of the enterprise behind the technology, creating a coiled spring effect. This gap won't stay open forever. Markets are eventually efficient, even if they are irrational in the short term. Now, part of staying ahead is making sure that you aren't tied to a single point of failure. Now, I'm always talking about the exchange redundancy strategy, right? Having multiple KYC'd accounts so that you are never locked out of your capital when the volatility hits. Now, I use things like BitGet, Blowfin, and Kraken because they are the most reliable names in the space, in my opinion. And right now, they're offering a 3%, or Kraken is actually offering a 3% cashback on cash and crypto deposits for new users who sign up with my link in the pinned comment down below. In that comment, you'll find a list of other exchanges that I use as a part of my redundancy strategy: Binance, Coinbase, Blowfin, BitGet, Kraken, and so many others. I make sure that I have KYC'd on as many exchanges as I possibly can. Banks evaluate XRP based on utility, cost savings, and efficiency, rather than Ripple's token ownership. This shifts the focus towards real-world utility and the institutional adoption potential for the entire ecosystem. David Swartz, now in his role as CTO Emeritus, has been vocal about this shift towards technical governance. Now, the launch of RLUSD has changed the game entirely. See, we aren't just talking about a settlement token anymore. We're talking about a stablecoin matrix designed to capture a piece of the $33 trillion addressable market. This is a plumbing for the new financial system. This is the stablecoin matrix. It visualizes the $33 trillion total addressable market for cross-border payments and treasury management. It shows how RLUSD isn't competing with XRP. It's the liquid bridge that makes the native token more attractive to the world's largest banks by providing a stable entry point. When you realize that RLUSD provides the stability and XRP provides the speed, you see the master plan. The corporate success of Ripple is in the foundation for the token's future utility. The pipes are being laid, the liquidity is being concentrated, and the math is starting to override the sentiment. Now, with all of that in mind, it does raise a question. What point does corporate success become a mechanical requirement for token value? Let me know your thoughts in the comments below. The supply shock isn't a theory, it is a mathematical inevitability being manufactured right now. Now, we are entering the final stages of the liquidity vacuum. The data shows that the elite are no longer just buying, they are securing their positions for a future where the public supply effectively hits zero. Now, to understand the scale of this, we do have to look at the numbers, and right now, holding exactly 46,400 XRP is enough to place you in the top 1% of all holders on the entire ledger. Now, this is the threshold that separates the retail crowd from the high net worth tier, and by reaching this target and moving those assets into self-custody, you are doing exactly what the institutions are doing, removing your tokens from the reachable market. This is the whale mirror path. It charts the three-step transition from exchange-held assets to sovereign wealth. Step 1 is the immediate withdrawal from exchange reserves. Step 2 is the migration to an offline hardware wallet, and Step 3 is the final entry into the top 1% bracket, effectively bypassing the 2.78 billion tokens currently sitting in the exchange danger zone. Self-custody is no longer just a security measure, it is a market-moving act. See, every token that you move into your own vault is one less token available for the banks to buy at these suppressed prices. You are essentially front-running a systemic shock by adopting the same protocols as the world's largest whales. And while the average investor is waiting for a green candle to feel safe, the smart money is busy locking the safe and throwing away the key. They know that when the 170 million token drain meets a returning of the global demand, well, the price, it won't just rise. It will teleport. We expect 2026 to accelerate structural shifts in digital asset investing. These trends should bring in new capital, broaden adoption among institutional investors, and bridge public blockchains more fully into mainstream finance. The current market fatigue is the final barrier then. This prolonged slump is designed to make you feel like the asset is dead, even as the fundamentals have never been stronger. But this exhaustion is the precursor to the feedback loop. Once the supply on exchanges drops below the critical insolvency threshold, even a small amount of buying pressure will cause the price to move violently. And when that happens, the people who sold at the bottom will be forced to buy back at the top, fueling the very explosion that they were trying to escape. This visualizes the moment that retail FOMO collides with the liquidity vacuum. As the public realizes the supply is gone, buy orders stack up against an empty order book. This creates a vertical price movement where the scarcity of the 2.78 billion tokens remaining on exchanges triggers a hyper-fast appreciation cycle that retail can no longer catch. This is the sovereign strike. You have the data, you have the proof of the ghost bot executions, and you can see the drain happening in real time. The institutional takeover is nearly complete, and the exit doors are narrowing every single day. You can either be part of the liquidity that the whales used to exit, or you can be a whale yourself. The choice is yours, but the math doesn't wait for anyone. If you want to see exactly how the supply metrics are shifting the global landscape for other major assets, make sure to click the video that's on the screen right now. I will see you all over there.